Alexander Hamilton was a big part in the national banking starting. He thought that the national banks would help best our nation's credit and help financially with business in the U.S. Um, he believed that banks should hold the power to give the people their money that they worked hard for. So then the National Bank was established in 1781 in Pennsylvania because the place where money was stored for the government, and that's where it was. The US was using all different kinds of currency like the English, Spanish, French, and Portuguese. So it was just nice for the national banking to give them their own currency now. And
The first one is talking about Federalists and federalism. So the Federalist Party banded together as a collection of bankers and a bunch of businessmen. They were all supporting Alexander Hamilton's policies that he had set up as beliefs in government and um, finance, etc.
so Thomas Jefferson, he was very against the national banking system because he believed that it would inflate and also deflate our currency so that it wouldn't be as valuable or it'd be way too valuable. Um, and then he also believed that it was against the Constitution, and he was also someone that was like there for the Constitution, so he was like a father of our country. So he like knows all about it being against the Constitution, and he believed that the banks just weren't for the people because he believed that they would not be able to handle the money well.
The first Bank of the United States was created by Congress on February 25, 1791. After the Revolutionary War, the U.S. had created lots of debt from the war, but each state had a different form of currency. So Hamilton made an idea for a central bank that would create a standard form of currency. Then, in 1812, the U.S. got into another war in the War of 1812 and had tried again to make a second attempt at a central bank. They had lots of debt from the war, so they created another central bank with the same responsibilities as the first in 1816, and it served as a place for government to deposit federal funds, and it was designed to ensure financial stability in the U.S.
The Wildcat Era, 1837 through 1862. In this time, there were only state-chartered banks existing. This was also known as the Free Banking Era. The banks were very short-lived, lasted only 5 years because the real value of the bank was often lower than the face value. The Bank Run video. This video showed how fractional reserve banking only kept a fraction of deposits in reserve and lent out the remainder, despite being a form of embezzlement and fraud, which is a universal practice in modern banking.
The greenback is 1860s money. It's a paper currency issued by the United States during the American Civil War. So before Civil War, the only money issued by the U.S. was gold and silver coins. And after that, because they need to pay all the countries and all the money, all the weapons, all the banks and all the weapons, so Abraham Lincoln tried to solve the financial issues, and in July 1861, Congress authorized $50 million in demand so they can use these greenbacks to pay the money, the weapons, and anything. And for gold standard, it's a monetary system where a country's currency or paper money has a very directly linked to gold. And it's a really old system, so most of the country use it until World War One. During World War One, in order to raise military, gold standard ends because all countries now use greenbacks to pay. And during 1924 to 1928, like the war ends, so they're trying to bring gold standard back, but it's impossible to restore since the basis of circulation of gold coins has been weakened. And during 1929 to 1933, all countries abandoned this standard system and implement the credit currency system. In August 1971, U.S. government stopped the dollar to exchange gold and the gold exchange standard system because it doesn't work anymore.
the 1929 stock market crash. This was a big cause of the Great Depression, an accelerated global economic collapse, and left about 15 million people unemployed.
The FDIC was created in 1933. FDR created the FDIC, and it was during the time of the Great Depression. He created it to provide stability to the economy and to the falling banking system. The FDIC guaranteed a specific amount of checking and savings deposits for its banks. Then fiat money was made in 1971. Richard Nixon was the first to instate this. Fiat money was paper money, and this was made to be legal tender. The SN loan crisis began in 1980 and ran throughout the 80s. This was the biggest bank collapse since the Great Depression. More than 1,000 SNL buildings had failed, which led to a cost of $160 billion.
To the second part, this is the subprime loans in 2005, an event that 25% of the United citizens that have been involved. Subprime loans means marketing loans to people who they may have difficulty maintaining the repayment schedule. But this loaning plan caused subprime mortgage crisis, and also caused by housing. It also caused by housing market crash. So, in the place that people are buying houses, so people, 25% of the United citizens choose this plan, subprime loans, to afford the money of it. But it had been a huge funds played a key role in the crisis, because there's a lot of problem for the banking, and there's also problem between two mayors about paying each other's, that causing a lot of problems. So for this part, basically you can understand as the loans plan that leads people to a crisis that cause they can't afford the houses, and some of the default cannot be returned in time. 2006 to 2009, house marketing crash happened in the United States, which this event, also known as United States housing bubble, it was a real estate bubble affecting over half of the United States. House pricing peaked in early 2006, which the housing price went really high up, which at a point that people cannot afford. But during 2007 and 8, the housing prices started lowering down, which is the highest drop of housing price that happened ever. And it also caused a recession in the United States. So for this part, overall, we can understand that during 2006, the house pricing started growing up very high and to a highest point, and then it dropped from 2007 to 2008. Well, cannot be returned in time. Okay, and the third part, which is foreclosure, it literally it means a legal process in which a lender attempts to recover the balance of the loans from a borrower who has stopped making payments to the lender by forcing the scale of asset used as a controller of the loan. But this thing, it happens in those two events. So this caused a foreclosure crisis. The foreclosure crisis took place during 2007 and 2010, and corresponded with high rates of foreclosure in the United States housing market due to subprime melted down and financial crisis of 2008, which is we already covered that before. The foreclosure crisis peaked in September 2010 when approximately 120,000 homes entered foreclosure in 1 month period. but its roots lay in a downturn in the housing market that began early in 2007 and blossomed in the crisis. So in the house marketing crash, it led to non-existent oversight of under process at mortgage banks, which frequently pocketed fees and promptly sold loans and other financial institutions, which failed to the appropriate due diligence in loans. When default rose, banks suddenly found themselves facing so many foreclosures events that they could not process them efficiently. In the same case, bank failed to initial foreclosure on home for a month after homeowners had cased too many payments. In other cases, record-keeping process had become so sloppy that bank cannot always so sure they actually owned mortgages for property being foreclosed. That's the crisis of foreclosure.
And that was in 1792, 1794. In 2008, the Emergency Economic Stabilization Act was set up, and it was kind of a bailout for the U.S. financial system, which was in need of help. It kind of took care of a mortgage crisis that was occurring at the time. There is a lot of issues going on with like the ownership gap. This is the last video that we had to watch. 2 to 3 people own their homes, and that's still a pretty big gap. And there's a lot of minority issues with home buyers, and there was a lot of money that was put out